Hello everyone, I'm Marg Franklin, President and CEO of CFA Institute. I'm thrilled to be speaking with you today about the Research Challenge, our 16th season of this incredible competition. Well done to all of you for your involvement and for making it this far. Your outstanding work is so impressive. To make it to the finals represents an incredible achievement in and of itself in the wake of the great challenges we've all experienced as citizens of the world over the past 2 years. We are so proud of your ability to give it your best and truly elevate this competition every year. This year, 6,400 students from more than 1,050 universities competed in challenges in 90 countries around the globe. This represents the largest number of participants ever in the 16-year history of this program. Wow, astonishing. For me, a career in the investment industry is truly exciting and a way to make a difference in the world. Our industry, it's fascinating. It covers a broad complex of skills and subjects, such as math, economics, politics, history, and even psychology. It's not all about the numbers. Employers today are looking for a broader range of skills from their staffs in order to deliver for their clients. Employers know that those who combine a professional credential grounded not only in technical skills, but backed with ethics and integrity, hold an edge in today's job market. I can assure you that those who earn the CFA Charter are a cut above and have demonstrated that they have the deep skills to be successful in this industry. The CFA Charter is so much more than a designation. It is the highest standard for all investment management professionals globally. Our charter holders have proven time and time again that they have the necessary dedication, perseverance, and commitment that our industry requires. When employers are looking to build teams, they're looking for these precise qualities, and achieving the charter demonstrates that you have them. Our industry plays a vital role in the global economy. We need a strong, vibrant financial system, particularly these days. We have a responsibility to collaborate across industries, and indeed across the globe, as it relates to solving some of the world's toughest challenges. There are actionable steps that we can take in conjunction to help define the way forward. These efforts require collaboration, education, and of course, capital. I'm inspired by the words of our mission at CFA Institute to lead the investment profession globally by promoting the highest standards of ethics, education, and professional excellence for the ultimate benefit of society. As you are pondering your future and what career path you may want to take, please keep that in mind. A career in investment management can really help to build a better world. I firmly believe that it's a career choice you can be proud of if you embrace that mission. We can help lead the way forward. And as you consider your career path, I hope your plans will include an aspiration to become a CFA charter holder. CFA Institute remains committed to helping the next generation of investment professionals find success in their careers. We have made significant progress around the world in expanding the reach of our organization and delivering value to those in our ecosystem. This competition stands as a testimony to that. This is indeed a global competition with student teams competing from practically every corner of the globe. And the future of our industry lies with you, the young investment professionals of tomorrow. This year also marks the 75th anniversary of CFA Institute. As I consider the progress we've made and the individuals that we've supported, the Research Challenge is a shining example of the impact we can have globally. I'm deeply proud of this program and extend my deep gratitude to everyone in our network who makes it possible each year. Thank you again for your participation and for being part of our journey here at CFA Institute. I'll now turn it over to Samantha Bray to continue today's program.
Thank you, Marg. My name is Samantha Bray, and I manage the Research Challenge here at CFA Institute. Kicking off this season about 10 months ago, while still being in the middle of a pandemic, we weren't entirely sure what to expect regarding participation. To our excitement, as Marg mentioned, this year's competition is officially the largest so far. And today, we have the top teams from around the world vying to become the next global champion. The 5 teams competing today are University of Sydney, representing CFA Society Sydney, Polytechnic University of Milan, representing CFA Society, Italy, IE Business School, representing CFA Society, Spain, Northern Illinois University, representing CFA Society, Chicago, and University of British Columbia, representing CFA Society, Okanagan, CFA Society, Vancouver, and CFA Society, Victoria. The teams will be evaluated by an esteemed panel of judges, including Joelle Arb, Portfolio Manager and Business Development Director, Octo Asset Management, Board Members, CFA Society, France. Jaime Lazaro, CFA, CEO, BBVA Asset Management, Mexico, President, CFA Society, Mexico. Cheryl Lee, CFA, Head of Asia, Teo Capital. Richard Segarra, CFA, COO, Director of Research, Ford Equity Research, London Stock Exchange Group, and Mark Temnikov, CFA, Portfolio Manager and Financial Analyst, Aton Ray Partners. Each team will have 10 minutes to present on their assigned subject company. Following the presentation, judges will have an additional 15 minutes to ask the teams questions. Once all 5 teams present, the judges will deliberate. We will then announce the winner of the 2022 CFA Institute Research Challenge. Before we get started, I want to recognize and thank our sponsors for making the Research Challenge possible. This year's sponsors include FactSet, Kaplan Schweizer, PGIM, S&P Global, the Princeton Review, and finally, Refinitiv, a London Stock Exchange Group business. Refinitiv is our official data services provider. They have been an integral partner in helping the students complete their reports and presentations by providing workspace access to all competition participants. At this time, I'm happy to turn it over to Indrani D, CFA, Head of Global Investment Research, London Stock Exchange Group, for a few remarks.
Hello everyone, I'm Indrani Day, Head of Global Investment Research at the London Stock Exchange, and I'm delighted to be here today at the CFA Research Challenge. My presentation, it's a very brief presentation, and I'm going to touch upon the fact of company and stock research, a few broad issues to consider. And again, there are no answers in this presentation. It's just some broad questions that become quite relevant as we are doing stock research. So the first point I want to highlight is the data. We use a lot of data in our research, but not all data is equal. And we need to be very clear on what are the sources of the data, at what frequency is that data getting reported, what is the integrity of that data, and if you're utilizing data from multiple sources, how comparable are they? Are we doing an apple-to-apple comparison? The second point I want to highlight is the ESG data points. Integrating ESG into investments has become mainstream in the investment world today. But there are a couple of different ways people consider ESG. First, a lot of people may say this is extra financial data. Some research will point that these are data points that actually impact the company's operations and then impact their financials, meaning ESG could be thought of as a leading indicator of a company's financial results. Couple of other issues. Are you utilizing ESG for regulatory purposes, or are you utilizing it to reduce your risk or increase your return, meaning improving your risk-adjusted return? Some questions out there. The third is considering the macroeconomic backdrop for stock research. And this has become particularly important since the last financial crisis around 2007, 2008. A lot of research shows that the macro factors are becoming a bigger proportion of a company's total return and risk profile. These are factors outside the company's control, but they impact the company's operations and financial results. Anything happening in the industry, anything happening on the regulatory front, whether it's already happened, about to happen. Then capital flows. Financial markets are very integrated. How is capital flowing across asset classes, across geographic markets? It'll impact the valuation and stock results. Fourth, research can be done in two ways. It's cross-sectional. How is the company today compared to its peers? And time series. How is this company right now relative to its own history? That's what I mean by saying, is it a good investment? Is it a good investment right now? And last but not the least, here we are concentrating on company research and stock research, but ultimately these individual stock picks will get into a portfolio will get constructed. And then for an active manager, are you adding value That question gets answered by how is your portfolio relative to how is the benchmark, which is why, while it's critical to know every stock pick, everything that's going into your portfolio, I would argue it's equally important to know what's there in the index or the benchmark that you are being measured against. So again, none of these were answers. These were just a couple of questions that I thought might be relevant. The last slide will just show the disclaimers, very important in the investment industry. So thank you again.
Thank you once again to Refinitiv and to all our other sponsors. At this time, our first team, University of Sydney, is getting ready to begin. Their presentation will start in just a few moments.
Find your best chance to pass the CFA exam the first time at Kaplan Schweizer. Take the guesswork out of exam prep with proven study materials tailored for your success. Get your complete study package today. Shop now.
ESG is responsible investing. Who's responsible for building ESG into your investments? At PGIM, the pursuit is on for outperformance. As active investors to outdeliver with customized strategies, integrating ESG best practices into our investment decisions. As asset managers and fiduciaries to outserve with our commitment to better ESG outcomes. Join the pursuit of outperformance at PGIM, the investment management business of Prudential.
University of Sydney, you may begin.
We present a buy recommendation with a 12-month target price of $15.95, representing a 14% upside. Following their successful acquisition of Sydney's largest ever toll road, Transurban has cemented its dominant market position within Australia. The group operates 21 toll roads across Australia and North America, with 93% of FY21 revenue generated in Australia. Transurban's key competitive advantage is their interconnected urban toll networks. Every single Transurban road is connected to at least one other Transurban road, which uniquely positions them to benefit from traffic synergies, unlike single road operators. Despite stringent Australian lockdowns in late 2021, traffic volumes are now matching or even exceeding pre-COVID levels on many of Transurban's roads. We also anticipate severe weather and COVID-19 will continue to cause public transport usage to remain muted in the medium term, whilst vehicle registrations continues to rise sharply as people shift towards preferring private transport. However, recent equity market volatility has resulted in a mispricing. Transurban has always traded at a premium multiple, but it is currently trading over one standard deviation lower than its average historical EV/EBITDA premium to listed infrastructure peers. We issue a buy recommendation driven by 1. Traffic volumes being boosted beyond market expectations by trucks and returning airport traffic. 2. Transurban's underappreciated market power, making them the natural heir to future toll road concessions. And 3. Transurban's inflation-hedged cash flows will provide investors with stability in a volatile market environment.
Transurban's traditionally stable traffic volumes have been hampered by domestic and international travel restrictions. However, as lockdowns in Australia are now in the rearview mirror, we expect rising truck and passenger vehicle volumes to exceed market expectations, driving a strong recovery in cash flows. Large vehicles, which account for 35% of Transurban's revenue, typically transport freight and building materials. However, a lack of rail infrastructure spending across Sydney, Melbourne, and Brisbane will continue to increase the reliance on trucks to transport freight. We expect this trend to be accelerated, since COVID-19 has pushed forward the demand for e-commerce and rapid freight solutions, whilst rail projects have lagged behind. For building materials, Transurban's roads are positioned close to ports, terminals, as well as major construction projects. Therefore, we expect strong truck traffic to be driven by a rise in both freight and building materials transportation. Specifically, large vehicles are tolled at a 2 to 3 times multiple, and we forecast large vehicle traffic to grow at a 6% CAGR through to FY25. This will result in proportional EBITDA margins expanding to 78% in FY25. However, market consensus of 75% implies only a 2.3% CAGR in truck traffic growth, which is in fact below pre-pandemic averages and is evidence of market underestimation. With regards to passenger vehicles, we view the return of domestic and international travel after lengthy lockdowns and border closures to be strong drivers of traffic recovery. 53% of Transurban's roadside revenue are direct connections to airports, with its networks forming key gateways in and out of capital cities. Record camper van and boat sales in Australia over the past year will also drive demand for road trips, and the lifting of travel restrictions around the world will support traffic around airports. As such, we expect traffic on key roads such as the Melbourne City Link to grow 51% by FY24.
We view Transurban as the natural heir to future Australian toll roads due to their quasi-monopoly position, with the market underestimating traffic synergies derived from such market power. Having acquired 17 of the past 18 Australian urban toll road concessions, we expect Transurban to experience similar success securing future extensions to their networks. Over its lifetime, Transurban has gained extensive expertise in operating toll roads and unparalleled understanding of traffic and cost advantages lowering their operating costs. This, coupled with Transurban's strong senior interest coverage ratio above 1.5 times free cash flow, positions the group to capitalize upon future opportunities. National budget deficits further incentivize privatization to provide governments with immediate cash. And even if Transurban does not acquire these new roads, new connections to its vast network expands Transurban's catchment area, offering traffic synergies in two ways. 1. New roads will divert users from alternative routes, and 2. New roads create routes to new regions. Both synergies affect connecting assets by adding a forecasted 1.5% of traffic above market expectations. Thus, simply forecasting organic traffic growth is misrepresentative of Transurban's size and its network.
Recent geopolitical and macroeconomic events have exacerbated equity market uncertainty, but Transurban's stable and inflation-proof cash flows makes it an ideal hedge against systematic volatility. Geopolitical tension in Europe, supply-driven inflation, and uncertainty in monetary policy have driven the S&P 500 Volatility Index to a 52-week high. In this volatile market, Australian infrastructure is attractive for its low systematic risk, evidenced by its low beta. Transurban has an even lower beta, yet maintains the highest gross annual return across the same 5-year period, presenting highly attractive risk-adjusted returns driven by the stability of its traffic volumes. Ongoing supply chain disruptions will lead to sustained inflationary pressures, but with 88% of its assets either pegged to CPI or set well above target inflation, Transurban will remain largely unaffected. The few remaining listed Australian infrastructure peers all face higher operational uncertainty, whereas highly inelastic toll roads are unlikely to see traffic volumes affected by macro and global events. Hence, we believe resilient cash flows in this period of uncertainty will lead to strong traffic numbers in FY22, catalysing a re-rate in Transurban's multiples back to its usual premium. Despite inherent operational challenges, Transurban has established itself as an industry pioneer through its ambitious ESG initiatives. Recent wind energy power purchase agreements will generate 80% of energy for New South Wales and Queensland operations, reducing emissions by a third in the next 2 years. Transurban has refitted its tunnels with energy-efficient LED lights and ventilation, repurposed old truck tyres into asphalt, and placed emphasis on reducing uphill gradients, which is where vehicles, especially trucks, pollute the most. These initiatives support Transurban's emissions goals, including net zero by 2050. Transurban is also making strides within the community, distributing 10 million in toll credits during COVID to alleviate the financial burdens of families, whilst installing 27 kilometres of noise-reducing walls. Despite operating in a male-dominated industry, Transurban's commitment to diversity is seen with a majority female executive committee, far exceeding ASX 200 averages. Management governance is also very strong, having achieved an injury rate significantly lower than construction peers. As a result, Transurban has attained ESG scores which leads comparable infra peers across 3 different financial data platforms.
Our valuation consists of an equity sum of the parts DCF weighted at 50%, dividend discount model weighted at 20%, and a relative valuation weighted at 30%, arriving at a target price of $15.95, which represents a 14% upside on last close. Our intrinsic valuation was derived by individually forecasting free cash flows to equity for each of Transurban's roads until concession expiry. Traffic growth was projected based on trucking and construction activity, traffic synergies, demographic trends, and historical characteristics of each road. To capture Transurban's unique operating characteristics, our relative valuation weighs 4 comparable sets: toll road pure players, European operators, Australian infrastructure, and global infrastructure. Transurban has historically traded at a 151% premium due to their superior market power and toll escalations. We expect this to continue, driven by Transurban's sustainable competitive advantage. Hence, instead of adopting a typical median trading multiples approach, our relative valuation compares Transurban's current EV to forward EBITDA premiums to its historical average premiums.
We recognise that there are 2 key downside risks to our recommendation. Firstly, there may be high oil prices, and secondly, regulation may block future acquisitions. However, after running a number of scenario analysis, we've decided that these are insignificant and do not change our target price. In conclusion, with rebounding traffic, Transurban's dominant market position, and its stable, inflation-proof cash flows, it's clear the light at the end of the tunnel is closer than ever. We are from the University of Sydney, representing the Asia Pacific. Thank you for listening. We now open the floor to questions.
I can start. Your thesis is built that the use of trains and buses will remain muted and people will transition to personal vehicles. I would like to discuss the regulation risk here. Do you see anything impacting this?
We don't recognize that there's much of a risk here. There's only some tolling reforms around the place, but we think that public transport will remain muted because of coronavirus concerns as well as funding concerns. So we don't think there's a big risk to our recommendation here.
And to add to this, if we flip the slide.
You go.
So to add to this, if we flick to this slide, we can see that the bottom graph there, that public road transport use has recovered compared to pre-pandemic. Whilst if we look at traffic volumes, if we look at public transport modes represented by the light green line, this has not recovered to pre-pandemic averages, and this is due to a number of reasons, including extreme weather events here in Sydney, as well as a general preference towards public transport due to continued fear of COVID. And at this point, no governments have introduced any regulations that will materially affect Transurban's traffic volumes, in our opinion.
Okay, and how does this connect to another pillar of the COVID reopening? So on one side, you're saying that this will remain muted due to COVID, but on the other side, you're betting on the reopening.
So we think that generally traffic is going to be going up when it comes to private transport. If we look at the traffic volumes on the same graph here, we can see that they are already on the very right-hand side, close to pre-COVID levels. Whereas with regards to public transport, because there is that public element where people are potentially exposed to COVID, and where there's still quite a number of cases in most states across Australia, we think that whilst the government has reduced regulations and there are no longer any restrictions on travel, people will still prefer private transport because they feel mentally safer within their own cars rather than riding on public transport where they are exposed to other people.
And just adding on to that, if we go back to that slide, Richard. If we go back to that slide, Richard, and if we look at the top chart, the top chart it illustrates the recovery of traffic on airport-linked roads, and we have seen a significant uplift, especially in the last few months, as we see that borders open up both within states in Australia as well as to overseas countries. We've seen a pickup in airport activity and associated traffic on the airport-linked roads.
Thank you. I'll take another question. Could you please elaborate on your analysis on oil price increase driving ahead inflation risk, please?
Yes, I'm happy to take that one. Richard, can we please go to slide 130? So whilst oil inflation remains a concern in people's in investors' heads, we think that because toll prices and oil prices don't actually constitute a majority of a household budget, and there's fiscal relief as well as OPEC relieving oil supply, we think that these contribute to oil prices decreasing in the near future. And even then, it requires a very high sustained oil price in order to have our recommendation flip from a buy to a hold. So we think that this is not a risk that poses a major threat to our recommendation.
Well, following on that question, the company recently said that in the near term, inflation was good for the company, and you present us one of the highlights that they have inflation hedge cash flow. So why do you think that the company is saying that in the near term, if inflation is good for the company?
Thank you for your question. I'm happy to take this one. If we flick to slide 135. So the majority, that is 88% of Transurban's roads, are hedged to inflation. So basically what that means is the higher CPI is, the higher they can charge for their tolls. And this is through an agreement with each of the state governments that they operate with. As a result, it means that if inflation is higher, their revenue margins actually, their overall margins actually expand because revenues will increase, but costs through their fixed contracts that they already have don't increase at the same rate. If we look at the sources of inflation in Australia, whether that's energy prices, supply chain disruptions, or labour market conditions, as you see on the left-hand side of the slide, we think that as a core infrastructure facilitating mobility, Transurban's actually going to be a beneficiary of the productivity improvement and continued public transport aversion. If we look at our sensitivities on the bottom right-hand side of the slide here, we can see that even when we sensitize inflation well above what the target rate is from the Reserve Bank, our share price is very minimally affected because of the hedging characteristics of Transurban's roads and how they allow for higher margins and do not actually disturb our recommendation.
And just adding on to that, we've historically observed quite a low elasticity of demand with regard to traffic on Transurban's toll roads. So we see that even if price goes up on Transurban's roads in line with inflation, we don't expect that to dramatically influence traffic.
Can you comment a bit on their leverage position, how they are managing their leverage? Do you think they're over leveraged, under leveraged? How is the position right now?
Yeah, I'm happy to take this. Richard, if we could please go to slide 90. Thank you. So despite COVID-19, Transurban demonstrated the ability to continue accessing debt capital markets while maintaining strong SACP ratings across all their underlying assets, which is unheard of for a global toll road operator with all their underlying assets being BBB+ rated. This is partly due to sort of their very prudent cost management, but also because during that COVID-19 period, they leveraged their strong Swiss bank relationships to issue a CHF loan at a coupon rate of around 0.875%, which was in a climate where the European investment grade credit spreads was 81 bips, 46 bips lower than comparable US investment grade credit spreads. And so as a result, if we go to the next slide, please, Richard. We can see that Transurban, not only with the actual asset credit ratings and the debt they've drawn down, but their debt book is quite robustly hedged against rising interest rates. And so they're well positioned in terms of their capital management that their debt book is well positioned to last through the next few years as their new assets come online and form the ability to capital release as well.
What's
Yeah,
their
just
coverage ratio at the
adding on to
moment?
that. The question is for
Sorry,
the
could you just
DC.
repeat your question that at the very end?
What's their coverage ratio?
Okay, so if we turn to the slide 13, sorry, on slide 12, we can see at the very bottom left, their interest coverage ratio is rising, we think, due to rebounding traffic. Right now, it's at approximately 2.8, and we see this actually increasing as traffic returns because this will increase their revenues post-COVID and obviously increase their ability to cover their interest payments.
And if we can flick to slide 93, Richard. So Transurban raises its debt on an asset-by-asset basis, and we can see that in FY21, some of their roads did experience a decline in their debt service coverage ratio due to a lack of traffic, especially in North America. However, given their strong bank relationships, they have been able to refinance their debt and to essentially allow for less covenant restrictions on their debt. And as we expect traffic to recover and the cash flows to recover, we expect their debt coverage ratio to improve over time.
For your DCF model, how much value is driven by each of the 4 factors then you incorporated in the model?
Right, and sorry, just to clarify there, when you say the 4 factors,
you said there were
do you
4
mean
factors on the slide that you've modeled
right?
separately?
Yep, correct. So those geographic characteristics that we do touch upon when considering each road's, I guess, proximity to ports, terminals, linkage to airports, surrounding land developments, and the network effect of connecting roads. But if we actually look at slide 117, we see how it's different depending on the region that each road is in. So if we look at the traffic assumptions for New South Wales, or for Sydney really, the period covers airport traffic recovery, freight rail development, the Parramatta CBD construction, and the FY26 opening of the Western Sydney Airport. So those were the factors that were considered there. And because Transurban's network in Sydney is quite large, it's very much the network effect as new roads come online that's driving growth. If we turn to the next slide, across Melbourne, Brisbane, and the North American roads, it's new roads coming online that really drive growth. With Melbourne, it's the Westgate Tunnel and CBD traffic recovering. For Brisbane, it's the forecasted uplift that comes from the Brisbane Olympics. And for North America, it's the lane expansions across their GWA express lanes. And beyond that, all roads are kept at a terminal growth rate of 1.5%.
And your valuation, you blended multiple valuation methods. Can you talk a little bit about how you did that and how you came to those weightings?
Sure.
Yeah.
Richard, if you can go to slide 120, please. So what we did was we chose 4 comparable sets to capture Transurban's unique characteristic as a pure play toll road player operating in Australia and as one of the largest global infrastructure firms in the world. So we constructed 4 peer sets, which is on slide 122. However, just staying on this slide, so what we did was we generated the historical daily EV to forward EBITDA multiples for Transurban, as well as each of the comparable sets. And then we'll compare the premium of Transurban's multiple on those comparable sets over the 5-year period. However, we see that currently Transurban is trading below one standard deviation for most of compared to its historical premium for most of the comparable sets. So we assume that Transurban will continue to trade at its historical premium because of its sustaining competitive advantage. So what we did was we applied the historical average premium to the comparable set's current EV/EBITDA multiple to arrive at what we think is a fair EV/EBITDA multiple for Transurban, and that's how we arrived at our relative valuation price.
And those 4 comparable sets were all equally weighted at 25% each.
Time. Thank you.
2 qualities best define today's data-driven global economy: volume and speed. S&P Global Market Intelligence is built to harness both. With billions of data points covering global market fundamentals to store-specific foot traffic, we transform raw data into actionable intelligence, enabling you to expand perspective, connect the seemingly unconnected, spot potential, then seize it. Teams of experts provide technology solutions that deliver timely, accurate data directly into critical workflows, driving greater efficiencies so business, government, and global markets can act quickly and make decisions with conviction. Whether supply chain insights, credit risk and ratings, private markets, economic indicators, or comprehensive ESG intelligence, the shift from quantity to quality is made at great velocity. We are here to accelerate. Are you? S&P Global Market Intelligence.
The world is changing. FactSet has embraced change for over 40 years. Our sophisticated financial data and analytics, powered by open, flexible technology, is redefining how, when, and where the investment community succeeds. Because when your platform is open, flexible, and agile, you can unlock value you never thought possible. Because in this new future, we need to see more, think bigger, and uncover what's possible together.
IE Business School, you may begin.
We are IE Business School and are initiating today our coverage on Santander with a buy recommendation at a target price of 3.76 euros, implying a 41.9% upside. Let's dive straight into the business and industry overview. Santander is one of the largest financial groups based in Spain. Thanks to its strategy centered around international diversification and numerous acquisitions, it has placed itself as the 4th largest bank in Europe. It is active in Europe, North America, and South America, with each of the region generating about 30% of the group's profits and the last 10% coming from its digital consumer bank. Aside of being a retail bank, which is more than 80% of its revenues, it also provides corporate and investment banking services, wealth management and insurance services, and PagoNext, a payment service. In terms of macroeconomic environment, we see it as being very positive for the banking sector, with South American rates at extremely high levels and North America and Europe expected to follow this hike trend. GDP and unemployment are also forecasted to reach more positive levels, in line with the recovery trends from the COVID crisis. These imply less need for provisions, thus further improving the bank's profitability. We issue a buy recommendation based on rate hikes driving net interest income in Santander's core geographies, a Spanish segment on the verge of a turnaround, a capital management that is misunderstood by the market, and Santander expected to close the valuation gap to its peers, leading to an upside potential of 41.9%.
Thanks, Kevin. We believe Banco Santander is better positioned than other European banks to benefit from 1, the rising rate environment, and 2, the loan growth picking up, thanks to its strong presence in Latin America, the US, and the UK. The pandemic has brought interest rates at another all-time low, putting the bank's profitability under pressure. However, the outlook for rates is improving, and we expect significant rate hikes in 6 of Santander's 9 core markets for 2022. With 64% of its revenue located outside of the Eurozone, Santander has a greater exposure to the rising rate environment than its Spanish counterparts. As you can see on the left-hand side, this is reflected by the positive sensitivity to rates in Spain, the UK, and the US, where we forecast rate hikes to trigger a major pricing of long-term assets and to drive the bank's bottom line. This is not the case in Brazil, where the negative rate sensitivity has been intensified by a 9% increase in the policy rate in the span of only 6 months. Yet, We do not expect this to burden the business momentum in Brazil, as loan growth remained strong, and we expect normalization of the yield curve in 2023. Finally, the end of the ECB long-term funding program will negatively impact Spanish banks. With the funding program contributing to only 1% of its NII, Santander exposure remains minimum compared to Spanish peers.
Moving on to the second point of our investment thesis, we are going to elaborate on the turnaround of the Spanish segment. As you can see in the chart, Spain has been traditionally an underperforming segment for the bank. However, with lower returns, this is still one of the main markets of Santander, which has been dragging down return on equity on a group level. We believe any improvement in this particular segment will likely push up ROTE for the whole group. Moreover, we believe Santander has already laid out the foundations for the turnaround of the segment to happen. The bank led the cost-cutting exercise in Spain, cutting more than 2,000 branches and 4,000 employees in the last 3 years, and it has reduced the cost-to-income ratio by more than any other major competitor in the region. At the same time, operating jaws at 11.5% are much stronger than Spanish peers. We believe these efficiency gains will help the bank to capitalize any improvement in the banking sector outlook and improve return on capital. Why do we think this is going to happen in the medium term? As you can see in the chart on the left, net mortgage production turned positive for the first time in the last 10 years in 2021, and we are confident that recent market share gains in mortgages, supported by a stronger pre-provisioning returns than peers, are a leading indicator of further improvement in the region and conversions of returns to the group level.
Thank you very much, Raul. Building on the Spanish turnaround, the market has penalized Santander for its low capital for too long. Unloading risk-weighted assets in strategic areas and working on improving regulatory requirement, Banco Santander has answered to the market's demand. Building on what they deemed as a low buffer zone of 189 bps pre-pandemic, strong organic capital generation, and a wish to close the gap with peers has brought CET1 ratio levels up 300 basis points above regulatory requirement. Basel IV is approaching fast, and Santander has taken the measured approach that we think is demonstrative of strong risk management. Impact expected to remain in the 30 bps region per management, but as previously mentioned, the stable business model and large geographic footprint leaves the company in a comfortable position should regulations be stricter than expected. As demonstrated by the European Banking Authority stress test conducted last year, Banco Santander has proven its resilient business model and ability to withstand important macroeconomic adverse conditions, with strong capital protection by 2023 only generating an impact on CET1 ratios of 240 bps against 500 across European peers. Overall, we feel comfortable with this coverage level and forecast it to remain in the 12% region. With the end of the moratorium suggested on dividends by the ECB during the pandemic, the bank has resumed their 40% shareholder retribution via a combination of dividends and share buyback. We forecast an increase of 42 bps per quarter in total payout ratio, settling at 45% by 2024. ROTE approaching 14%, capital ratio sufficiently covered, and share price trading below tangible book value all offer an interesting equity story for further share buyback at attractive recapitalization levels. However, despite this strong shareholder retribution, Banco Santander still trades at a discount. With a 32% discount on the average price-to-book value ratio among European banks, the market has for long insisted that 1. Low capitalization level, and 2. Conglomerate structure justify it. This market view can also be seen expressed in the implied cost of equity nearing 15%, while its Spanish peers closer to the 11% region.
Let's now dive into our valuation analysis. We based our target price on both intrinsic and relative valuation methods as outlined on this slide. Overall, all of our methods indicate similar levels with upside, and weighting them equally results in a target price of 3.76 euros. For relative valuation, we selected peers for each region that had a similar business model and were large enough for comparison. We looked at both the price-to-earnings ratio and the price-to-book value ratio over the next 2 years in our analysis. For the dividend discount model, we looked at each region separately given the huge differences in terms of risks. This is reflected by different levels in both cost of equity and growth rates that we applied, as you can see on the left side of this slide. In this model, the main contributors to value turn out to be Spain, UK, US, Brazil, Chile, and the digital consumer bank. For our justified price to book value ratio, we took the forecasted return on equity over the next 3 years and applied a weighted average cost of equity and perpetuity growth. This resulted in a 48% upside potential. We also conducted a bull and bear analysis with differences in expectations for exchange rates, interest rates, GDP, and unemployment. Particularly noticeable here is that even our bear case scenario results in a 20% upside potential.
The three key risks to our buy recommendation are the foreign currency risk against euro due to potential political instability in Latin America, the risk to miss on a cost-cutting plan because of inflation, and the large exposure to the booming UK mortgage market that can potentially lead to increased loan loss provisions in 2022. Adding to that, there is a new geopolitical risk due to the Russian-Ukraine conflict. As we can see from the table above, Santander's exposure to both Russia and Ukraine remains minimal. Irrespective of how the conflict is going to evolve, we already see it impacting the global growth outlook and the financial sector in particular. As we can see from the chart on the left, the drop in Santander's share price during the most heated period of the conflict still remains lower than on average for its peers. Now let's move to ESG. Santander has consistent A rating across all the three pillars. It is a signatory of PRI and reports in accordance to the Global Reporting Initiative. As we can see from the table on the right, compared to its peers, Santander, while not best in class, is still doing quite well on various ESG-related indices. We see that the bank is setting long-term targets, and we like the pace at which it is meeting them. The main highlights are that are reducing portfolio exposure to high-emitting sectors and deferring up to 36% of variable compensation for executive directors until 2024, subject to meeting long-term targets.
Thanks, Anna. Santander is a hidden bull among Spanish banks. We restate our buy recommendation driven by rate hike across core geographies, a Spanish segment on the verge of a turnaround, misunderstood capital levels, and finally, an opportunity to close the gap on valuation metric with peers. Thank you very much.
Thank
maybe
you.
I'll start.
Please go on.
I'll start very quickly. A lot of your investment thesis surround the recovery of Spain. How about Latin America? How does the macroeconomic outlook of Latin America impact the share price of Santander?
I can take this one. So the business momentum in Brazil, because Brazil is the main geography within South America, was very strong since the end of the pandemic. I mean, loan growth was positive, and right now we're seeing that loan growth is slowing down, and banks are restricting access to credit, and we're also seeing that the asset quality is starting to deteriorate. So we would not be very bullish on the growth outlook for Brazil as a result. And the second thing with Latin America, which is very important for Santander, would be the effect on foreign exchange. Sorry, if we go to slide slide 129, we can see that if in the event that 19. In the event that there is a major deterioration of the Brazilian real, it would have a significant effect on profits at the group level. So, growth outlook in Latin America are not as good as they look right out of the gate at the pandemic.
Is that considered in your valuation?
Maybe I can also pitch in. Actually, we took that into account. We have updated our model that depends because a bank a bank's financials, a bank's performance depends a lot, especially for retail banks, on the interest rate levels and the yield curve, right? And so we have updated it according to the latest forecast of the interest rates in each of the region that Santander is involved in South America. So that is priced in our model, yes. And we have also adapted the provisions given the risks that we see in each one of the countries separately. If you wish, we can also go more into details. We have the financials here. Maybe Anna, just to briefly show, or could you, Anna, just to briefly show? Yes, you can see here that we forecasted every region separately. So yes, it is priced in.
Okay. Thanks.
Well, in the Mexican market, Citibank is selling its retail business, and Santander has mentioned that they have interest in buying or be one of the bidders of the bank. This is expected to be between 10 and 15 billion US dollars. So do you think that if they go and buy the retail business of Citi in Mexico, can impact the capital structure, especially after the capital misunderstanding by the market that you mentioned, and the impact on your valuation, please?
So I can begin with that one. So thank you very much for your question. If it is true that a Citi is trying to sell Banamex, so in Mexico, but in our point of view, we don't believe that Santander will actually go for it, despite having said it openly in their last earnings call that it should maybe be a consideration in Q3 2022. But we do not believe that they will engage in it because it will first eat a lot of capital. They expect it to hit the capital ratios in approximately between 70 basis points and 130 basis points. So we do not believe in terms of capital structure that right now Santander is well positioned to take advantage of this opportunity in the Mexican market.
And maybe to shortly add on that, it is also unlikely that Santander will actually be allowed from the Mexican government to acquire Banamex, because it would mean that Santander and BBVA both will control, I think, more than 50% of the market in Mexico, and that would create something close to a duopoly, and it is likely that the Mexican government will not allow for that. So we do not see it as likely to be happening.
I have a question about you compare peers based on the common equity tier 1 ratio, and I have a problem that you in this ratio you're using risk-weighted assets, and it depends on national regulation, different characteristics of the banks. Have you compared the same peers just purely on the leverage ratio? Because it's a common practice to use both ratios together to see the differences.
Mm-hmm. So I can begin with that. So if I understood correctly, you're wondering if we've also checked the leverage ratio with the CET1 ratio. So in terms of CET1 ratio, Santander is actually, if Anna, you can take us to slide 41. So Santander, due to its global systematic importance, they are actually required to post a 1% over CET1 ratio of capital to protect it. And in addition to that, they are also forced by the Spanish regulation and bank. If you go to the next slide, they are also obliged by the Banco de España to post a certain level of collateral, as they represent an important weight into the banking sector in Spain.
Okay, I was just wondering about purely financial leverage ratio, if you have looked at that one.
If you go back, I am not sure I have it right now in the deck.
Actually, if you go to slide 83 on the peer selection, you will see that these are the metrics that we looked at when we selected the peers for each of the region, because we wanted to analyze each region separately and to do our sum of the parts analysis. And these are all of the metrics that we looked at. So the level of leverage itself was not a key criteria for us.
Okay, and one more quick question. I saw on the slide that you attributed some probabilities to the outcomes of the Russian-Ukrainian crisis. How did you come up with those numbers?
Right. I could take this question. So when we're assigning probabilities, we actually analyzed certain reports from available sources and from Bloomberg Research, that were analyzing the conflict. At the period when we were first doing it, the first scenario seemed more possible. Now it looks like we are in the second scenario, actually, but yeah, the source for it was basically Bloomberg and the other external data providers.
Well, Santander recently announced that the share buyback program was completed. And I wanted to ask you, without this buyer, how could the stock react, or is this considered in your model because they are not going to have the same support for the price of the stock?
Yes. So as you said, Santander has actually finished quite recently their share buyback program, but we expect them to continue probably end of the year to support the price. Not to support the price, but as the price offers quite an interesting, as the stock right now represents an interesting price for them to buy, we believe that at the end of the year they will resume it with their dividends, because in their last earnings call, actually management was committed towards continuing on their paths of shareholder retribution, which they had to stop during the pandemic. So right now, as you said, they are stopping it, but we believe that probably Q3 or Q4 2022, they will resume it back. Yeah.
I'm just wondering, this 42% upside, what you see then the market doesn't see?
Maybe I can answer to that one. So actually, the 42% upside might look a bit exaggerated at the moment because there was a recent a drop in the share price. And if you go on the slide 32, you will see at the very end that there is a drop right now that happened. And we feel that this is unjustified. This is, of course, due to the fact that there is a possibility that Europe goes into a recession because of the increasing prices and the Russia-Ukraine conflict. But we do not see Santander, as Anna was explaining before, as being directly affected by it, which is why we still remain bullish on all of our main investment thesis. And that's why the 42% might seem a bit bigger. Other than that, our main investment thesis points are something that we believe the market has not priced in.
And just to add on, Kevin, on the last earnings call, we've actually been seeing one of our investment thesis, namely the Spanish turnaround, materializing partially, not fully, but there is a signal that the Spanish segment is actually cutting costs and will be a good value provider in the next year.
A lot of your analysis is focused on the geographical, difference. How about in terms of industry exposure? How is the loan book exposed to different industry, and how does that impact the analysis?
Yeah, so I think I can take that one. So Anna, if you can go to the slide number, it's asset quality, slide 49, Appendix C.
Sure.
Yeah, you can go to the next slide, please.
Mm-hmm.
Yeah, so we actually thought it was very important to take a look into this because with COVID-19, we wanted to know which kind of exposure to industries our bank has compared to other banks. We did that analysis with peers in the Spanish market. But as you can see, we listed all the industries by how much impacted by COVID-19 they were. And actually, Santander in the first table you can see is the bank with less exposure to the four most affected industries by COVID-19. So in that sense, we feel the bank is protected because even though COVID-19, it was already 2 years ago, these industries haven't recovered yet, especially in Europe. So it's still a problem to have a high exposure to these industries in the loan book. So in that sense, we feel protected with the asset quality of the bank.
And just to build on that, if we go to slide 35. So this is the loan book exposure in terms of the breakdown between mortgages, consumer, and corporates, and they've got quite large exposure to mortgages. But of course, this varies from country to country, and it's different for every geography.
A quick question: what would you, or what factors would make you change your recommendation?
Maybe I can jump in that one. The main thing that we would see right now would be the recession in Europe actually taking form, because that would impact, of course, the loan growth and therefore our net interest income, our forecasted net interest income for Santander. And that would also mean that higher provisions would be needed. And of course, that is the biggest risk that we see today for Santander, and that would change our valuation downwards. It would have to materialize more, and right now we don't see it as being 100% sure, but that would be the biggest potential change in our valuation.
If I may add something to this, we've also been looking at the provisioning policy of the bank compared to other banks, and we feel like Santander has been provisioning more, has been doing more provisions than other banks. So in that sense, even if we see a recession, we feel like the bank will be more protected than.
Thank you.
Hey folks, I'm Rob Franek, editor-in-chief here at the Princeton Review, bringing you good news about our CFA program. Pass rates on the new computer-based CFA test are at historic lows, causing so much fear and anxiety. Our program has 3 bedrock tenets to help our students succeed. 1, laser-focused study notes. 2, online practice questions and exams that mirror the real test. And 3, our instructors are Herculean in their prep abilities. We do hope that you'll place your faith in our team. It would be an honor to have you as our students.
Polytechnic University of Milan, you may begin.
Science fiction is becoming science facts, and now companies need to embrace technology to survive the market. The digital race is on. Good morning, everybody. I'm Andrea from Polytechnico di Milano, and today, with my colleagues, we will present our 44% upside case on Reply, the winning company you must bet on right now. The company is one of the main players in the European IT service industry, and it's going to surf the big wave of digitalization. The digital market is booming. Europe is under unprecedented government push to move forward, but demand is the main driver of this boost. Today, the company priority is sustainability from an economic and an ESG standpoint. Well, digitalization is the answer for both, since it provides sustainable competitive advantage and it's the main facilitator of the ESG transformation. That said, what are companies really looking for? Their investments are focused on digital enablers, advanced technologies like AI and IoT, which enable digital transformation at its best. Their market is forecasted to grow at a stable double-digit CAGR in the next years, and this directly translates into greater demand for IT services, expected to double their growth and reach a market size of 69 billion euros in 2024. Easy money, right? Well, it's not that easy. The industry is a real battlefield. We have big brands like Accenture and Capgemini, but also low-cost players offering commoditized services at a highly competitive price. So, in such a competitive industry, why Reply? Well, because it's no more about the biggest, it's about the fastest, and Reply has a unique ability to anticipate competitors in targeting the most innovative technological niches. Since its foundation in 1996, Reply tells us a story of exponential and outperforming growth, reaching revenues of 1.5 billion spread among Europe and the US. Our investment case is driven by three catalysts: a unique organizational model enabling early adoption, an undervalued human capital, which is the core asset in a people-intensive business, and a mix shift leading to higher profitability. Now, Francesco will present you the network model.
How can Reply be the fastest and anticipate competitors? Actually, Reply is not a single big company. It's a big network of more than 150 small subsidiaries, each of them specialized in a technological niche. The network allows the agility and the flexibility to position on the most promising market niches, winning the race for early adoption. Comparing the last 10 years annual reports of the company with the ones of Accenture and Capgemini, we noticed how Reply adopted every emerging technology at least 1 year before its competitors. The early adoption ensured a sustainable competitive advantage and a best-in-class profitability, with an EBIT margin of 14%. To stay on top of innovation in such a dynamic industry, the network model needs to constantly evolve. Reply's growth strategy is based on bolt-on acquisitions, which provide an average 2.3% contribution to the top-line growth. Now, it's a people-intensive industry, so let's talk about people. We believe investors are underestimating the core asset of the company, its workforce. But how can we state this? To assess the human capital value of a company, we developed a proprietary framework that estimates the value generated by each worker, starting from its capitalized cost. Reply has the highest value per employee among its peers. But what are investors getting from this? Well, high human capital means high value generation capability, and Reply stands out for its high profitability, more than twice the industry average. Reply also demonstrates a superior capability to leverage its workforce, with a 5.6% return on human capital. The company differentiates from its peers thanks to its exclusively onshore hiring policy, which has a positive social impact, fostering local employment. This policy, aimed to secure the best talents in the market, will allow Reply to focus on high value-added services, further improving the value added per employee. This, combined with a larger employee base, will result in a substantial expansion of the operating profit. Now Alberto will guide you through the third catalyst and the valuation.
Some of you might associate Reply, a player in the IT service industry, with the traditional and not so appealing system integration. Well, forget it. We reclassify the total revenue of the company with the bottom-up approach based on each subsidiary's financial statement and their website. And what we discovered is actually impressive. While most of its peers still have the majority of their business coming from standard software implementation, Reply's business portfolio is undergoing a mix shift toward digital enablers. We called Advanced Technological Solution the segment including subsidiaries which design innovative solutions based on these technologies, already representing Reply's core business. Reply is increasingly focusing on this segment to capitalize on the mass expansion of digital enablers, which will account for 60% of total revenues in 5 years. The increase in profitability will be backed by the international expansion. The highly profitable American market, with a size of 136 billion, offers tremendous opportunities for the company. The US, where Reply entered in 2018 with Valorem's acquisition, currently represents the main focus of the M&A campaign. As such, we forecast a 14% exposure to this market by 2026. At that time, we expect the operating margin to reach 14.5%. Now, let's see how these three drivers impact our valuation. An equal blend of discount cash flow model and relative valuation, leading to a year-end target price of 180 euro per share. The first stage of the DCF accounts for a 5 year of strong growth, surfing the big wave of digital enablers and relying on a 3.6% of inorganic growth. This, combined with the profitability improvement, will boost the cash generation of the company, with net cash expected to overcome 600 million in 5 years. After a normalization period, the terminal value is being computed with the perpetual growth rate of 3.15% and the discount rate of 6.82%. The result is a target price of 182 euro per share, which proves its robustness to the main valuation risks. What about relative valuation? Let's discuss it with Alessandro.
Our multiple analysis is based on our proprietary model, identifying EV on human capital as the most appropriate multiple to compare Reply with 7 IT service peers. We obtain a 42% upside, given by a 1.5-year end target multiple. This multiple, even backed by traditional ones, positions the company between two clusters. The full digital player, completely focused on digital technologies, and the diversified ones, which also provide commoditized services and traditional consulting activities. Despite the growing similarity with the full digital player, Reply still trades at 29% discount. Therefore, we expect a potential repricing of the stock, considering it should trade at multiples aligned with this top-tier cluster. Coming to ESG assessment, Reply's sustainable performances showed a substantial improvement over the last 3 years, moving from a double B in 2018 to a single A in 2020, filling the gap with the industry average. On the environmental side, Reply operates in a low carbon-intensive industry and represents an eco-friendly investment thanks to its relevant impact on Scope 4 emissions. Moving to the social pillar, the company stands out for its focus on hiring young graduates, which represent around 65% of total hirings in 2020. Moreover, Reply strategically hires exclusively onshore personnel, fostering local employment. Governance is the biggest company weakness. Our main concerns are related to insider ownership, with the decisional power in the hands of the Rizzante family. Besides, we show a red flag on the poor disclosure policy adopted by the management. Now, I leave the floor to Gianluca for further considerations.
Let's now take a look at what potential investors may ask. The first key question is, how would the company handle any M&A risk? This risk is certainly concerning, especially after Portal Tech. This British company was acquired by the group, and then its revenue went down by more than a half. This apart, the company has a long history of successful acquisitions. Management has now improved the scouting process, stressing the synergies of the network model, and continue to avoid transformational deals. So, when they took over Valorem in the US, its revenue doubled and the EBIT margin almost tripled in 3 short years. In addition, should you be worried about the downward trend in the stock price since the start of 2022? The answer is most definitely no. This trend is determined by purely exogenous events. First, there was the rise in real long-term interest rates, which does not influence the EPS growth prospects, but affects the discount rate. The second event is the uncertainty caused by the Ukraine crisis, which we know is affecting the global market. That said, it has no impact on the company's intrinsic value, backed by the resilience of the IT industry, which has always reacted to periods of demand slowdown. More than react, rebound. Just look at COVID-19. We will put our neck out and not see them as a real threat, but rather as the opportunity for a good entry point. To conclude, we will restate our buy recommendation on Reply with a 44% upside and a near target price of 180 euro per share. The digital wave is coming. Get ready to surf. Thank you for the attention, and now the floor is open for questions.
Thank you for your presentation. May you please provide some color on how you model the top line growth, margins, and how the service mix shift affects the evolution of those margins, please?
Yeah, sure. Starting from the top line growth, in our first stage of DCF, the top line growth, the organic top line growth is about 10.8%, and it's the result of a correlation between the organic growth of Reply and the growth of the underlying market of digital enablers. Since in this market, given that Reply is not a developer but is a service provider, its revenue benefit most when the technology reach the mass expansion. And we are really dealing with years in which many technologies like artificial intelligence and IoT and many other are now really ready to reach the mass expansion, and the result is this impressive 10.8 organic growth for Reply. Then for what concerns the inorganic growth, there is this contribution of the M&A, which is around 3.6%, which has always been part of the total organic growth, on the total top line growth. And then talking about the margins, our mix shift is one of the key drivers behind the evolution on the EBIT margin. And to better understand where does this mix shift came from, we have to start from the reclassification of the portfolio of Reply that we provide in our analysis, thanks to our analysis of the shareholders meetings in which the company disclosure each subsidiary's financial statement, and we went for more than 150 subsidiaries, reclassifying them in these 4 business lines, so namely software implementation, the ones related to the implementation of SAP, Microsoft, Oracle, and advanced technological solution as the main 2 ones. For what concerns advanced technological solution, we are dealing with subsidiaries which design innovative solutions based on artificial intelligence, cloud computing, and all these other digital enablers. What we understood through this reclassification is that there is this segment of advanced technological solution which is both the highest profitable with an 18% EBIT margin, but also the fastest growing segment for the company. And so projecting this pace of different growth for the future years, we aim to identify that the overall exposure of the company to this digital enabler sector is going to increase. And more specifically, we talk about 60% exposure by 2026. So the overall contribution on the EBIT margin is going to be that the EBIT margin will increase at the level of 14.5% in 2026.
Well, is the growth that you are projecting incorporated in a 30 times P multiple? How cheap is the company if the technological sector is suffering from a rising interest rate environment?
It is true that the actual tech environment is suffering from the rise of interest rates. As a matter of fact, as we can see here in the slide, we are speaking about a 90% correlation with the Reply share performance with respect to the Nasdaq index, which we took as a sort of benchmark for assessing the value of the tech market. It should be noticed, however, that, as you currently mentioned, we are dealing with an increasing trend in terms of interest rates, which is even backed by a macroeconomic scenario, which is for sure uncertain. And this will lead the company to suffer in the short term from this uncertainty given by these 2 macroeconomic events that will for sure impact the market in the short term. However, it should be noticed that Reply has very strong fundamentals, as even confirmed by our projection in terms of EPS, and we are dealing about 60% in the last 5 years, which is even projected for the coming 5 years more. And so, this is even confirmed by the latest release of the company, which occurred about 1 hour ago in terms of the first quarter. And we are speaking about 25% of top line growth, which is a value far above the value of the result of the last quarters, where the top line growth was about 14%. So we are dealing with the company with a flourish future that is capable through its network model to serve all the emerging technologies that the company will even develop in the coming years. And so we are not worried about the downward trend of the stock price in the last years.
In addition, we want to underline that actually this moment is just a good entry point to buy the stock. Indeed, also in the past, Reply suffered from exogenous events, as we can see from the slide, with huge downside in its stock price. However, as my colleague said, Reply has strong fundamentals, and thanks to its strong fundamentals, has been able to recover from the losses in just 1 month. Moreover, in 6 months, as we can see from the slide, the company is able to reach huge upside, as in the case of the rising of interest rates in 2018, with a 38% upside in 6 months.
Can you speak about your return on human capital a little bit more? What is the denominator there? How is that measured? And then secondly, how do higher wage inflation, how does that impact that particular measure?
First of all, we need to start from the reason why we chose to adopt the human capital model, which is because this is a people-intensive business, so people play a critical role in the value creation process. And with our model, we wanted to capture the intangible value that people provide to companies in the IT service industry. To compute this model, we started from the geographical reclassification and the competencies of the employees, and we obtained the human capital value, which is the value that people can provide to both Reply and its customers, because having onshore people like Reply does increases the value for the customer, because Reply operates mainly in Europe and the US and has most of its customers located in this region. So having an employee base which is close to the customers adds a lot of value, both in terms of language and in terms of time for example. And so this is our cost-based approach, because the human capital value is a cost-based approach that has also implication on the profitability side. In fact, as we can see in the slide, Reply has the highest value per employee among its peers, and this directly translates into the highest EBIT per employee, which has a value of around 20,000 euros and is more than double with respect to the industry average, which has a value of around 9,000 euros per employee.
In addition, we also introduced an innovative metric, such as the return on human capital, to, let's say, take into account the strategy, because an investor might think that the offshore policy will lead to higher returns, higher profitability, but that's not the case. Indeed, we can see that Reply, with its onshore policy, has the best return on human capital, 110 basis points more than the industry average, showing so that with its onshore policy, Reply is able to capitalize its workforce and to create value.
Concluding with wage inflation, which is for sure one of the hottest topics at the moment, we need to notice that Reply is actually influenced by inflation, mainly through wage inflation, since we are dealing a cost structure which is 80% exposed to cost of personnel. As you can see here in the slide, Reply has already dealt with wage inflation in the last 10 years, passing from a cost per employee close to 65,000 euros to about 75 in 2020. However, in the IT service industry, companies tend to revert the impact of inflation on customers. And so, as you can see on the slide on the right, about the revenue per employee, Reply has, in the last 10 years, a constantly increasing revenue per employee, thus testifying not only the mix shift that the company is currently undertaking, but even this phenomenon of reverting back the impact of inflation on customers. Therefore, we are not worried about the impact of inflation on the profitability of the company.
And specifically, Reply here has two advantages. One is related to the cost. As we can see here in the wage inflation chart at the right, the company mainly operates for a major part in Italy, which has a rigid labor law, and so the impacts of wage inflation are low. And regarding the revenue, the company operates with short-term contracts, which allow the company, which are around 1 year of length. And these allow the company, as my colleague was saying, to revert more fast than competitors these costs on the price side.
A lot about IT projects is surrounds speed. So what is the average project implementation speed vis-a-vis their competitors out there?
Sorry, could you please repeat your question?
So have you looked at how fast or what's the period of implementation, IT project implementation speed versus the competitors like Capgemini and the large MNCs that you have shown as their competitors?
Yeah, companies like Accenture and Capgemini operate generally with longer term project because they have a significant portion of their business coming from activities like, for example, business process outsourcing, which represent recurring revenues and therefore require higher, longer term projects. However, this leads to lower profitability performances because the services which Replies focuses on provide higher EBIT margins, like the ones that we mentioned before with the software, with the advanced technological solutions, while low value added activities like the ones, for example, of Accenture and Capgemini are less profitable than the ones that Reply focuses on.
Sorry, so what's their cash cycle versus the competitors? Do you have it?
Yes, for what concerns the cash flows of the company, and the company is currently outperforming its competitors in terms of cash performances. You can see here a significant in growing in the free cash flow of the company, also thanks to good management of the working capital over the last years, and particularly we are talking about the reduction in the DSO of the company. We can also show you an analysis which sees the free cash flow performances of the company compared to the Euro stocks companies. And if we go to these slides, we can appreciate that the company is really one of a kind company in terms of cash performances. If we consider metrics such as the level of debt and the sales CAGR of these companies, and the downside months, the revaluation in the free cash flow of the company, and lastly the growing of the last 10 years in terms of free cash flow, we really obtain a limited top tier class which Reply joins. So again, also from this point of view, representing a one of a kind company even compared to the European stocks.
A question about
what are your
ESG.
thoughts on the Area 42 Development Center for investment in robotics, blockchain, the metaverse? Is this the future of the company, or they have to stick to solutions like the quantum inspired algorithms and the things that they are already giving to the market?
Yeah, sorry. Yes, that's a really crucial point for the strategic positioning of the company. If we can go back to the slide of the service portfolio, we can see that the company really focuses on the advanced technological solution segment, which comprises all the solutions based on cutting-edge technologies regarding of the period when we are. Right now, these cutting-edge technologies are cloud computing, IoT, artificial intelligence, especially autonomies of things. And this allows the company to provide services which are really on the edge of technology and profit with an 18% EBIT margin. So you mentioned technologies that are really on the edge of reaching the mass expansion. And so the company is really focusing also on that, also on blockchain, and also on the quantum computing, yes. And still, this is about the fast. Right now, the company is really fast by targeting niches that allows them to focus on continuously new technologies and provide the solutions that the competitors does not at the moment.
Focusing on quantum computing, for instance, the company in the last month developed a project with Enel, which include the application of quantum computing for the improvement of the operations of the company. And this has strictly impact on the scope for emission that we introduced for our ESG assessment on the environmental pillar. And we are dealing with avoided or reduced emission that customers can benefit from the application of Reply projects. And so by implementing projects of Reply, the real impact that Reply has on environment is strictly related to the benefit of scope for emission, given the fact that we are dealing with a low carbon intensive industry.
What drove the ESG score from BB to A? Where the stock is now and where the company is going?
We are not speaking about a huge improvement of the company by
Time. Thank you.
The world is changing. FactSet has embraced change for over 40 years. Our sophisticated financial data and analytics, powered by open, flexible technology, is redefining how, when, and where the investment community succeeds. Because when your platform is open, flexible, and agile, you can unlock value you never thought possible. Because in this new future, we need to see more, think bigger, and uncover what's possible together.
Are you looking to gain a competitive advantage? Kaplan Swayzer has been helping candidates earn the CFA charter for more than 30 years. From the renowned Swayzer notes and expert-led classes to custom Q-banks and realistic mock exams, Swayzer gives you the best chance to pass. As a business, you can help your employees become CFA charter holders. We'll customize a corporate training program to meet the unique needs of your organization. Visit swayzer.com to start your journey to the CFA charter.
Northern Illinois University, you may begin.
Founded in 1928, Motorola is a public safety communications equipment industry giant that pioneered car radios and cellular phones. Headed by CEO Greg Brown since the company's 2011 split, Motorola provides land mobile radio networks, video security and analytics, and command center software to governments and commercial customers. Motorola leads its peers in terms of ESG transparency. Its environmental policy focuses on waste reduction, climate impact, and supplier practices that mitigate mineral mining consequences, yet could be improved by disclosing its renewable energy utilization. The positive industry recognition for its social programs focuses on its launch of DEI and data protection C-suite officers, its pandemic-driven measures to protect its workforce, and its foundation support of fallen first responder dependents. However, controversy surrounds its West Bank ground surveillance provided to Israel. Governance is Motorola's weakest area. Despite its institutional oversight and one share, one vote structure, its CEO compensation is excessive relative to peers, and its dual CEO board chair appointment introduces agency problems. While no one company competes in all of Motorola's technologies, its main competitors in each include L3 Harrison Land Mobile Radio, Axon Enterprise in video security and analytics, and Tyler Technologies and command center software. Industry tailwinds displayed on the left include federal, state, and local public safety spending, corporate IT expenditures, and cybersecurity attacks. Our buy recommendation is driven by three main factors: Motorola's land mobile radio economic moat, its high growth adjacency acquisitions, and its expanding margins. Motorola's land mobile radio domestic and global market dominance creates a moat, which, according to our survey of 1,000 first responders, is supported by high switching costs from sunk infrastructure investments and sticky long-term contracts. Motorola then boosts revenue by upselling to captured customers, such as the 6% of additional revenue generated in Q1 by its groundbreaking Apex Next radio. Motorola also cross-sells its other technologies to captive customers. It has hastened its penetration into these less protected, faster-growing video security and analytics and command center software markets via acquisitions at a rate that exceeds its technology peer groups and closest competitors. Motorola's service-heavy adjacency acquisitions have also improved operating margins by 290 basis points over the last 6 years. We expect that future adjacency acquisitions will result in software and services accounting for half of overall revenue by 2030, driving overall gross margin up to 57%.
Next, we will discuss current and forward-looking financial metrics. To project revenues through 2031, we separately regress products and systems and software service revenues on historic drivers, a subset of which can be seen at the right. Then, we pair significant coefficients with driver forecasts. We then integrate the assumption that acquisitions will focus on service targets within the video and command center technologies. Consequently, we expect that overall sales growth will stabilize at 3.9% annually and that gross profit margins will improve by 8.4% throughout the forecast period. Using management disclosed targets, we prioritize cash flow allocation. Specifically, we expect Motorola will spend 20% of operating cash flows towards capital expenditures. Similarly, to fund software service acquisitions, we assume Motorola will spend 37.5% of operating cash flows. Motorola has paid and increased dividends nearly continuously. We assume that they'll honor this commitment with 30% of operating cash flows. We also expect that they'll return wealth via repurchases, doing so with 12.5% of operating cash flows. Motorola's heavy debt load has led to a relatively excessive debt-to-EBITDA ratio, lower credit rating, and outlook. Despite the bankruptcy potential suggested by its Altman Z-score, their default probability is less than peer averages. All of Motorola's current debt obligations are fixed, alleviating interest rate risks. Additionally, their newly increased $2.37 billion revolver acts as a floating source of liquidity. Our valuation is based off a free cash flow to the firm discounted cash flow model. We arrive at our $258 12-month target price by growing the 2031 FCFF perpetually, then discounting all cash flows at the firm's WACC. The terminal growth rate is based upon a weighted average of GDP growth expectations in Motorola's three main geographic operating markets. Our 9.7% WACC, which incorporates recent interest rate increases, ESG considerations through an ESG adjusted beta, and major rate operating market adjustments, exceeds Motorola's current and historic estimated cost of capital. Our 258 estimate is most sensitive to increases in WACC and cost of goods sold. However, these risks are mitigated by our conservative equity risk premium and Motorola's gross profit margins, which are expected to continue expanding through their focus in software service acquisitions. The resulting upside beats S&P 500 analysts' 2022 expected returns.
To support our primary valuation, we additionally turn to different valuation techniques. Our first scenario analysis adjusts individual drivers to create bull and bear markets, producing a $321 and $190 target price, respectively. Our second scenario analysis, which randomly adjusts assumptions across 1 million Monte Carlo durations, produces a $263 implied valuation. And our third scenario analysis uses Brownian motion to simulate 1,252 trading day price path and yields a $260 target price. To confirm our FCFF model, we next discount its projected dividend stream across three considered scenarios, including a base case, which generates a $266 valuation. We then pair averages of key trading multiples of its three technology peer groups with Motorola forecast to estimate firm value, such as the EV to EBITDA suggested $258 target price. As a final validity check, factor analysis supports our projected upside with a forecasted 24.24% return, and risk-return metrics verify Motorola's superiority above its peers. While there are many factors that could impact our valuation, we're going to focus on the 5 most impactful ones. Looking first at inflation, in anticipation of potential future spikes, Motorola has tightened its contract-embedded CPI price escalators to more thoroughly counteract interest rate and margin impacts. Although pandemic-spurred global supply chain disruptions have dramatically increased backlogs, Motorola's DEI-motivated selection process creates a more flexible and geographically diverse supplier base. Additionally, its projected shift towards services decreases the impact of delivery exceptions. Acquisition integration could face headwinds, which delay revenue realization past the 2 years our model assumes. However, we expect Motorola to mitigate synergetic mishap impacts by continuing to monitor acquisition success and divest, if need be, as it has done in the recent past. Now, turning towards the political front, the valuation blow Motorola would incur if its effective tax rate rises to the Biden administration's proposed corporate tax rate, may be lessened by leveraging foreign tax credits to partially offset domestic liabilities. And finally, Motorola's operations are heavily regulated, introducing compliance costs and decreasing competitiveness. However, its political action committee is very active, diversifies its risk by lobbying across the aisle. In conclusion, Motorola's economic mode, coupled with its strategic adjacency acquisitions in less protected technologies with favorable margins, are the three main factors that drive our buy recommendation. Now, we'd like to open the floor to your questions. Thank you.
Okay. We just saw on the last report that the company beat both on sales and earnings per share, and maintained the 2022 outlook. Do you think this is sustainable despite the supply chain constraints, or is this a threat for your valuation?
Absolutely. In terms of its sustainability, we agree with management that the earnings forecast for the full year is sustainable, specifically based on their strategic shift towards software and services, which is higher margin and less subject to those variable input costs. And Paula, if you want to talk about the supply chain as well.
Yes, absolutely. Thank you, Nolan. Obviously, management talked a lot about supply chain constraints and how they were successfully mitigating it, exploring those new substitutes, shifting to more towards services. They did mention that freight costs increased because they're trying to get parts faster through airplane delivery. And with the Ukraine invasion, those costs increased, but they have been successful in mitigating it by exploring those substitutes, increasing inventory, and those mitigating measures.
For the revenue projections, you mentioned the regression and certain sensitivities. May you please comment on those?
Absolutely. So Nolan, within the financial analysis section within the main presentation. Thank you. So how we derived top line growth was we used two parts. One was the statistical analyses across 50 or so factors taken from Statista, and we regressed them on both their products and systems revenues and software service revenues. And then we found which ones were statistically significant and used those as long as they had forecasted values to project future revenues. Additionally, we also have a 2-year implementation lag of any accretive revenues given by acquisitions that Motorola incurs within our model.
And if you're using this regression, how can you be sure that these sensitivities stay the same for the next 10 years?
So we would only use the forecast for the next couple of years. Additionally, we only used statistics that had previous decades of data. So we looked to make sure that, for example, worldwide IT spending, global cybersecurity expenditures, it wasn't just from 2018 to 2021. We wanted to make sure that they had spanning years of data and that they were stable but still proved to be significant.
How do you justify the inclusion of the country risk premium in your equity risk premium?
Yeah, absolutely. So Nolan, if you can go within our cost of capital slide within the appendix. So looking at this, our country risk premium is 70 basis points, and that's to reflect a weighted average of sovereign debt differentials between revenue weighted the Motorola's 3 main geographic markets. That's Canada, United States, and the UK. That's how we derive the 70 basis points. And then the equity risk premium, which I mentioned was extra conservative, we added an additional 150 basis points compared to the Demoteran's 5% April estimate, as well as 50 basis points from the academic average of 6%, just for extra conservatism due to the volatility with inflation, interest rates, geopolitical risks, and other unforeseen factors that could occur in the next 10 years.
Could you please elaborate on that profile and the impact of increase of rates on the following refinancing, please?
Absolutely. So in terms of how Motorola finances its debt, it's all currently at a fixed rate. However, we do forecast that they will have to tap into their revolver in order to address liquidity issues relating to their large acquisition spending that we forecast. So the interest rate risk would occur there if interest rates continue to rise. However, as you see on the left, Motorola has a large debt issuance due in 2024, ranging all the way to 2031, and those are all currently at fixed rates, alleviating that interest rate risk.
Is the acquisition of the UK-based company Calypsa a good move for Motorola Solutions? Why or why not?
Absolutely. In terms of looking at adding Calypsa to Motorola's current portfolio, it's really accretive for the company because the company is looking to shift many of its services to the cloud specifically. And Calypsa has expertise in moving video security and analytics to the cloud so that Motorola can provide those value added services for its existing video security and analytics customers.
Um, are the prices, the increased cost of semiconductors, freight costs, logistic costs, and whatnot, is there pricing in your fair value, and how?
Yes, absolutely. In terms of looking at our forecasted income statement, we adopted management's guidance on stagnation in gross profits year over year from 2021 to 2022, specifically related to those heightened semiconductor costs. However, because of Motorola's economic moat, it can push strategic price increases onto its customers to preserve gross margins year over year.
But it seems like your cost of sales is decreasing from what I'm looking at, and the expenses are also decreasing. That's what you're projecting?
Yeah, the initial outlook was through 2022 stagnation, and then after supply chain constraints are resolved, per management's guidance, looking at 2023, the supply chain constraints being solved largely, that's when their gross margin continues to a downward trend as it has done in the past, with its shift towards software and services.
What are your assumptions for the Monte Carlo analysis?
Absolutely. So in terms of our assumptions for the Monte Carlo, we adjust key drivers simultaneously, such as cost of goods sold, SG&A, effective tax rate, days receivable, days payable, as well as our capital allocation, such as our acquisitions as a percentage of OCF, using historical averages and standard deviations over an 8-year period. So adjusting those key factors simultaneously to determine what our median target price would be.
You mentioned improved transparency in terms of ESG. Could you go further and just discuss the I would say the profile, ESG profile of the company?
Absolutely, great question. Nolan, if you could please take us within the main slide to our ESG overview. So one thing that Motorola does really well is their disclosure. They're actually performing better than any of their peers that we selected as their specific peers in the industries. We do mention in terms of energy, the renewable energy utilization, that's where they can improve. But in general, they have really good environment and social scores. In terms of governance, this is where we see the most improvement. We do have the CEO board chair appointment where Greg Brown, as the CEO, is also the board of directors chair, which does impose the agency problem of also having high compensation. But Nolan, if you could please go within our compensation slide. We do say that one issue is that he has a relative excessive compensation. As we can see to the bottom left, the CEO pay ratio is fairly high compared to the other peers. However, in the top left, we see that a lot of it are stock awards, so performance-based compensation. And he has been doing a really good job in turning the company around and being a leader in the past 10 years, has been with Motorola for a very long time. So to the bottom right, as we can see, as the stock price increases, his compensation also increases. So therefore, we do not see it as that much of a risk.
Does the company set any targets for the environment concerns?
Yes. So one thing that they said they want to reduce, Nolan, within the slide, main slide deck, please, the overview. Reducing recycling rate or increasing recycling rates, so increasing recycling. And then their focus areas are what they said is GHG emissions. So they really aim at reducing those, and they have been doing this in the past. And then within environmental products and mineral sourcing, that is where their closed loop supply chain within the Congo comes in. So they are addressing diversity, equity, and inclusion also a lot within social focus. Data security, cybersecurity is very important. So they are really active in ESG and are a leader actually in ESG compared to the peer universe.
But did they set any specific year or number for the greenhouse
numbers?
transfer?
Which specific one are you referring to? For example,
for example, for emissions.
For emissions, they want to get to, so for example, in terms of scope 1 and 2 emissions, they want to reduce it, and they actually already achieved this by 35%.
What are they doing in terms of waste reduction, specifically e-waste, since Motorola is producing a lot of those?
E-waste, and in terms of mineral sourcing, something that is really important for them is that they are, we do know that lamp or radio, their substances, they are regards to e-waste, but the closed loop supply chain is first of all very important, and then also high recycling rates and just making sure that they are responsible. And one thing that they also do, if we go to Nolan within the appendix, the MTech, please. Just in terms of, they have a committee from various different areas where they all come together and make sure that their products are ethically responsible in terms of their cybersecurity solutions, but then also in terms of environments and just in general, that they are in line with the ethics of the industry.
But like exactly what actions has been taken?
Well, one action that they are taking is they're going more away from land mobile radio to video security and analytic substances. So making this still a very important business of them, but focusing also on those cloud-based solutions more in depth.
Speaking of M&A, have there been any instances of integration risk, or do you foresee it in the future?
Yeah, absolutely. So Nolan, could you go to the acquisition integration risk within the main slide? So they have been very active, as you may recall, an acquisition timeline slide that we showed earlier with acquisitions specifically. Since our first valuation, they've incurred 4 new acquisitions, one being yesterday, actually. However, management is very good at making sure that they can monitor these acquisitions and divest. And as we can see here from 2018 to today, they have made 3 divestments with TRX Systems, Agent, and Amanon.
Do you have a detailed EBITDA bridge, EBITDA, or to give more color on the margin evolution?
Are you asking in terms of EBITDA?
Yeah.
Mhm. So in terms of the way that their EBITDA has been trending, we forecast that it returns to around 2019 levels by 2026. So that's a really conservative outlook, given their rapid shift towards software and services.
Time. Thank you.
Hey folks, I'm Rob Franek, editor-in-chief here at the Princeton Review, bringing you good news about our CFA program. Pass rates on the new computer-based CFA test are at historic lows, causing so much fear and anxiety. Our program has 3 bedrock tenets to help our students succeed. 1, laser-focused study notes. 2, online practice questions and exams that mirror the real test. And 3, our instructors are Herculean in their prep abilities. We do hope that you'll place your faith in our team. It would be an honor to have you as our students.
2 qualities best define today's data-driven global economy: volume and speed. S&P Global Market Intelligence is built to harness both. With billions of data points covering global market fundamentals to store-specific foot traffic, we transform raw data into actionable intelligence, enabling you to expand perspective, connect the seemingly unconnected, spot potential, then seize it. Teams of experts provide technology solutions that deliver timely, accurate data directly into critical workflows, driving greater efficiencies so business, government, and global markets can act quickly and make decisions with conviction. Whether supply chain insights, credit risk and ratings, private markets, economic indicators, or comprehensive ESG intelligence, the shift from quantity to quality is made at great velocity. We are here to accelerate. Are you? S&P Global Market Intelligence.
University of British Columbia, you may begin.
I'd like you to close your eyes for a second and imagine. You're on a ship. She's not the prettiest. She's no shining white yacht, but she's beautiful in her own way. Powerful steel, painted red, rusted and scarred by the unforgiving sea. And around you, as far as your eyes can see, is nothing but endless blue, ocean fading into sky. You're on a vessel owned by Atlas Corp, a holding company with 2 subsidiaries, Seaspan Corporation and recently acquired APR Energy. Judges, myself and my teammates from the University of British Columbia are pleased to present you our buy recommendation for Atlas Corp with a $16.50 US target price representing a 28.71% upside. Our analysis primarily focuses on Seaspan Corporation as it comprises 88% of Atlas EBITDA. Despite recent global geopolitical tension, we remain strong on our buy recommendation and believe that Atlas Corp is undervalued by the market. Now, before we dive into details about Atlas, a little bit about the industry they primarily operate in, marine freight. Most of the world's goods are transported by sea. Of the primary marine freight industry segments, container shipping comprises about 1/3 of the industry total. The industry is defined by 3 key business segments: containerized, dry bulk, and liquid bulk transportation. The industry is also characterized by 3 key business functions: asset or ship ownership, management, and operations, not unlike that of a commercial building. Given that marine vessels transport goods for world trade, industry demand is extremely elastic and driven by major macroeconomic factors like global GDP, consumer spending, and crude oil price. However, industry supply is inelastic in the short run due to the cost and time required to construct a new ship. This supply shortage, particularly recently, has resulted in higher freight and time charter prices. So where does C-SPAN fit in?
C-SPAN serves as a container ship leasing company. Looking at its revenue, the majority of that comes from major international carriers. C-SPAN at the moment has 132 vessels with an overall capacity of 2 million TEUs. If we were to look at the competitive positioning for C-SPAN, we see that it is the largest container ship only leaser on the market by market capitalization. On the other hand, APR Energy is the other portion of Atlas's business. It is a power generation solution. It was acquired by Atlas back in 2019 as an attempt to diversify its portfolio and apply its asset leasing model to the energy industry. APR has a fleet of 2 gigawatt and has experience operating in over 35 different countries. Under Atlas's control, they continue to acquire new contracts and form new strategic partnerships. Today, we have 3 main reasons as to why we believe Atlas is a strong buy. First, in terms of its greener new build vessel programs, we see that Atlas expects 69 new vessels with an overall contracted cash flow of $11.5 billion against an overall cost of $7.6 billion. We note that 25 of these vessels are LNG-powered ships, which will enable Atlas to take advantage of stricter environmental regulations as well as increased demand for cleaner vessels. Secondly, Atlas has a strong and resilient business model, especially to market fluctuation, because charter ships don't bear voyage costs, which are the highest volatility costs.
Our third thesis is that Atlas has superior access to capital and is ensuring they maintain a disciplined capital allocation system. As you can see, Atlas holds significantly more debt than its competitors. However, they still have a current credit rating that is competitive with other industry leaders. They're also making one of their primary goals to achieve investment grade rating, which will result in even better financing in comparison to industry peers. Furthermore, Atlas has a diversified debt system and a global syndicate of supportive lenders. They are backed heavily by Fairfax Financial Holdings, who has shown to be willing to increase their stake in the company. These reasons indicate strong institutional confidence in the future financial prospects of the company. Now, Atlas Corp, in comparison to their peers, has a healthy balance sheet that supports growth, and ratio analysis has indicated to us that Atlas is either in line with peer companies or stronger for major leverage and liquidity metrics. We can see that their historical debt-to-equity ratio is slightly higher than industry average. However, they maintain a consistently stronger interest coverage ratio. Atlas also consistently beats out peers in terms of ROE, even through the pandemic. Furthermore, we found that historically, Atlas's free cash flow over sales has been in line with peers with an anomaly pandemic year.
To capitalize on this balance sheet, we believe that C-SPAN's new build program, which has been fully financed, will generate a strong revenue pipeline that's based in heavily contracted charters. We forecasted sales based on fleet size, charter rates, and utilization rate, which we expect to stay constant at around 98%. For APR, we hold power capacity constant for the next 4 years and grow electricity price with GDP in Latin America. Furthermore, we grow utilization over time as APR transitions to focus on longer contracts. C-SPAN's cost of revenue refers to the vessel operating costs, crew wages, and other maintenance and repair costs. Since revenue is fixed by long-term charters, we forecast costs on a per TEU basis, and we see that it's consistently decreased over the past 5 years. However, we believe that inflation in the near term may lead to temporary margin compression as wages and labor costs rise. After this period, we believe that the costs will return to their historical stagnation, leading to no change in real dollar terms. Finally, we believe that capital expenditures will increase in the short term to fund the new build program. Since CapEx has historically composed of maintenance and growth, we think that for the next 4 years is going to be filled by vessel commitments, after which it will only compose of maintenance CapEx. We derived our target price of $16.50 based on a 70, 20, and 10% weighting of DCF, net asset, and relative valuation. We decided on this weighting due to the predictability of C-SPAN's cash flows with fixed contracts, the asset-heavy nature of the industry, and the lack of appropriate competitors with similar business and financing mixes. And the football field summarizes our valuation approaches. For DCF, we forecasted a 10-year horizon to account for fixed charter lengths before using a terminal growth rate after 2031. We base this on the projected growth of the shipping industry and the key geographies that Atlas operates in, and picks our exit multiple based on the industries as well. We further used a 2-stage WACC to represent the deleveraging process. Although Atlas operates in a relatively stable industry, we still need to account for potential risks to cash flows. For example, cost of revenues may be impacted heavier by inflationary pressures. And therefore, we have 3 scenarios, and the assumptions that we varied are detailed here. We believe that the benefits far outweigh the costs. For example, Atlas must lose at least 15% of utilization before it realizes a negative return, which we believe is highly unlikely. Secondly, we performed a net asset valuation. Since Atlas operates in an asset-heavy industry, we determined its P/NAV ratio in comparison to peers, and we took APR's asset value at acquisition and accounted for depreciation and asset disposals. We discounted future charter cash flows and examined fleet composition to determine market values. As shown here, Atlas P/NAV ratio of 0.4 is below the peer average of 0.43.
Finally, we conducted a relative valuation of Atlas Corp using comparable companies for both C-SPAN and APR. We based these comparables on their similarity in business models, capital structure, fleet size with respect to market share, and profitability. We then used the median multiples for both peer groups to determine a weighted average industry multiple. Comparing this to Atlas's multiples, we found that the company is trading at a premium compared to its peers. However, we expect that this premium will persist in the following years. The relative valuation resulted in a 13.1% upside. Now, in the macro environment, Atlas is affected by numerous factors. Based on these external factors and internal company characteristics, we have identified 10 different investment risks tied to Atlas. We found the most impactful to be the geopolitical tension due to the Russia-Ukraine invasion and the potential for overconstruction of vessels as short-term demand rises. These risks are mitigated by the desirability of C-SPAN's new build fleet and the salvage value of the vessels.
For our ESG analysis of Atlas, keeping in mind Sustainalytics as well as the IMO, we rate them at an overall score of 7.3 out of 10. Our score is primarily driven by C-SPAN's industry-leading environmental efforts, although pulled down by some social and governance concerns. Firstly, C-SPAN operates in an economically important industry with no commercially viable low-carbon alternatives. Despite this, between the 25 LNG-powered vessels, their SAVER program, the sustainability-linked bonds, C-SPAN is well-positioned to align themselves with the International Maritime Organization's climate strategy of reducing carbon dioxide by 40% by 2030. Furthermore, Atlas has a satisfactory social rating. From improved crew safety to Hong Kong flagged ships, C-SPAN's overall executive team consists of 33% female compared to an industry average of 5%. Our only concern here is that the majority of the vessel crew is primarily hired from India in order to take advantage of lower wages. Finally, in terms of governance, we observe that Atlas has a stellar board of directors and executive team. Our only concern here is share concentration, given that Fairfax Financial Holdings, which is a firm similar to a Canadian Berkshire Hathaway, holds about 46% of the common shares, while Dennis R. Washington holds 18% of the common shares. We note that while this is a downside for governance, it is actually a good side in terms of financial growth because we have a strong financial backing.
Judges, as the container ship you're aboard glides into a glittering port, between C-SPAN's new build program, resilient business structure, and focus on rating, we hope you share our conclusion that Atlas Corp is a buy with a 28.71% upside and $16.50 target price. Thank you.
I have a question on your capacity. So the TEU capacity versus its competitors, how is the historical utilization rate versus its competitors, and what is projected? I think you mentioned you project a stable utilization rate moving forward. So with the increase of TEU capacity, do you think that the utilization rate will be stable, and why?
Yeah, absolutely. I can take this question. So when we were looking at forecasting container ships, leasing that segment of the business, we looked at the existing contracts and the charter lengths that they have, and a lot of these contracts are actually they're made for 10 years, 24 years, and so on. So it's actually a very long charter length time, and after which we sort of forecasted based on market demand, which we believe is going to sort of return to pre-COVID levels by then. So that's why we have our utilization rate sort of hovering around, you can see here, we have it hovering around 98.5% or so for 2023 and all the way to 2031, where we kind of forecasted slowly going down to about 98% utilization. And that utilization, we do think is going to stay constant at around that rate, because we do find that when we look at in comparison to their competitors, as you've mentioned. When we look at competitors, we see that C-SPAN actually has a much higher contracted duration in terms of the contracts, and they have much higher contracted revenue, which is why we don't believe this is the decrease in utilization rate is a high risk to C-SPAN. And even if it is a risk, we do account for it in our sensitivity and scenario analysis. So when we looked at conducting scenario analysis, we said, what if utilization rate drops to 90%? What if it drops to 86%? What if it drops to 74%? And we find that it's only if they dropped 15% all the way to 70% that we changed this recommendation to a sell, which is really unlikely because historically, if we look at past 10 years, their lowest utilization rate has been around 95%. And so going to 74% would mean that they suddenly lost a significant customer. Thanks.
Where's the APR energy valuation in the overall valuation that you have?
Sure, I can take this one. So at the moment, APR Energy consists about 12% of the overall company's EBITDA compared to C-SPAN, which I believe still holds a majority of that EBITDA of like 88%. And we've sort of taken that very conservative approach, understanding that we don't know whether or not APR is going to be growing long term. And if we actually swap to the strategic plan, the way that APR kind of aligns itself with C-SPAN, and it might seem like a weird mix at the beginning, is that it's in terms of three different areas. In terms of alternative fuel, because we see that C-SPAN as a company is trying to transition and break into sort of an environmental leading efforts. At the moment, looking at sort of the shipping industry as a whole, a lot of people, what they're doing, a lot of competitors, they're kind of holding back on seeing what is the best source of fuel and holding back on that. And while C-SPAN is actually actively trying to invest to try to be one of the first movers in order to capitalize in the industry, especially as we kind of see potential emergence of like green corridors or more sustainably linked ships and bonds, etc. The second way, sort of how APR ties into the valuation, is if we look at back into the financials, we've kind of been very conservative with the overall forecasted growth. A lot of analysts in their reports state that APR is estimated to grow significantly at around 20%. We've kind of forecasted APR's growth to be pretty stagnant over the next 5 years in order to just be conservative, making sure that this doesn't affect our valuation, that the bulk of our valuation is still mostly dependent on C-SPAN as a business, since it is the core business at the moment of Atlas. And furthermore, just kind of one add-on to that, in terms of APR and how they're doing under Atlas's overall control, we see that they're actually increasing in sort of the contracts. If we go to sort of the APR fleet deployment schedule that we have in the appendix, we see that they're actually transitioning into slightly longer contract rates as well. So in the past, they've been mostly kind of operating under short-term contracts because of state grid stability projects, etc. And we see that APR is really under the span of Atlas, really trying to transition into longer, more safer contracted cash flows. And that's exactly what we see here. I can go into more detail on some of the projects, but that sort of hopefully answers your question.
How do you justify the weights for your overall valuation? I mean, you also mentioned that there is a lack of competitors. Why do you even assign 10% to the relative valuation?
Yeah, so I can comment on relative weighting, and Ashwin could sort of comment on relative valuation. So when we were looking at overall value, determining the weighting of the overall valuation, we sort of thought what would make the most sense for Atlas, given the way that the company is structured and given the industry that it operates in. So we thought, okay, Atlas has very high contracted cash flows. A lot of their contracts are extending, 10 years, more than 10 years into the future. So we thought that the DCF valuation should be weighted significantly higher. So that's why we weighted DCF at 70%, because we think that the contracted cash flows sort of provide a stable revenue driver, as opposed to, for example, tech companies, which don't really have that stability of cash flows. So that's one with DCF. And then with NAV valuation, we wanted to use NAV valuation and weighted higher than relative valuation because it is an asset heavy industry. So worst comes to worst, what what Atlas can do is after the contracts expire, they sell off other ships, they sell off APR, they get rid of all of that. And we think, okay, we evaluate the value based on their net assets total. And then with relative valuation, Ashwin can sort of speak to why we don't have, we didn't really see a mix of appropriate competitors.
Yeah, so we mainly saw that lack of appropriate mix with competitors for
Well,
APR
with
energy. They were very
recent
unique.
warrants exercised by Fairfax Financial Holdings, around 25 million common shares, now they own more than 50% of the company. Do you see any relevant changes in the governance or strategy of the firm? Why or why not?
Yeah, so I can take that to begin, and then I think James can jump in as well in terms of governance. So we definitely recognize that as a governance issue. So it's definitely a twofold situation here. One where we do show that the shareholders are confident in the growth of the company, and that is great as they're exercising their warrants, and that has $200 million more to pay down the debt. However, there definitely is a governance situation here, and I think Atlas has also spoken about diversifying their investors and their debt holders as well, so that Fairfax Financial Holdings does not have the sole power in the company. So I think James can talk a little bit more about the governance situation there.
Yeah, kind of expanding on that. When we sort of went through our presentation, we did make note of the fact that this is a relatively high kind of shareholder concentration, especially in terms of Fairfax. Although on the governance side, it might seem a little bit on sort of the riskier side for individual investors. This could potentially be actually a good side and a positive side on the financial side, because Fairfax Financials, I believe we have an appendix side there, has an extremely strong track record of financial performance, of investing in companies in terms of value-based companies. And we see that even during the 2008 era, where a lot of the companies and their equivalents are actually not performing well, Fairfax Financials actually was able to kind of still have a really good portfolio holding in relative of their peers. And we see that Fairfax also adds as a very strong financial backing for Atlas. So some of the debt sort of issuance and financial side actually came from Fairfax Financials as well. So it's a really strong sort of core support group for Atlas, especially since we're playing in such a heavy comp industry. It's really important for Atlas to have a strong financial backer. And that's essentially how sort of Fairfax and financial acts in terms of Atlas.
Speaking of that, you mentioned the company is very disciplined. Do they have any covenants, especially given their net debt to EBITDA levels?
Yeah, that's a good question. So I can take that as well.
Go ahead, James.
Go for it, Ashwin.
Okay, I was just going to say in terms of their strategy their strategy going forward for the debt, you can see that the senior unsecured notes are going up a lot higher. So to get the investment grade credit rating that we were speaking to, one of the things they wanted to do was, of course, maintain a high interest coverage ratio and continue deleveraging. But they also want to shift towards a more flexible unsecured capital structure, so they're not having to put up their vessels in terms of secured notes. So you can see that going up there, and that's how we see the path to investment grade rating happening. And we also forecasted a net debt to EBITDA ratio going down significantly going forward till 2031.
Does management have any target? And for the covenants, I didn't hear the answer. Maybe there was a...
So in regards to the targets, so the way that they haven't stated explicit targets, but the way that they've sort of looked at, the way that we sort of see it is with the Atlas versus Danaos. So when we think about Atlas versus Danaos, Danaos also took on a significant new build program initially, and then they deleveraged over time. And so that's where we sort of see Atlas following down that path.
Free cash flow have been negative for like the last 2 years. So how are they planning to deleverage?
A lot of their deleveraging is going to come from, again, the new build program. So when they do the new build program and the cash flows start coming in, that's when they're, like, again, it's sort of similar to what Danaos did. And let me just go through Danaos slide.
And
So
just
when
while
we look
Sally's
at
finding that, another quick deleveraging strategy that they're doing, as was mentioned before, with the exercising of the warrants for 25 million common shares, that added $200 million in cash that they said is going to go towards the deleveraging process.
So that's what we sort of have. The Atlas, we see it following down a similar trajectory to Danaos, which deleveraged from 7.3 to 2.5 in 2021.
One other thing just to add on as well is this high leverage and what you can see with Danaos and what we have seen and will be seeing again with Atlas is this is just the nature of the industry, because their assets, container ships, are such high value items. It is necessary to assume this much debt and then deleverage it with cash flows from the, like there's initially obviously a large negative cash flow because they're paying the cost of constructing the vessel and not receiving any cash flows. And then once they start receiving cash flows from those vessels, that helps with that. And I mean, as well, Atlas already, as we mentioned before, already has contracted cash flows for all of the vessels they're getting built. So they do not order vessels unless they have a contract in place for those vessels.
Okay, thank you. That's very clear. Just to understand, has economic contraction, or let's say a recession, potential recession, has been taken into account in your valuation?
Yeah, for sure. So I can jump in on this one as well. Right now, just sort of looking at container ship market outlooks, the outlooks are very positive moving forward. If we look historically at what's happened, if we look at the market and the effect of the 2007 financial crisis, which is one of the most significant recent economic events on any company, obviously, but particularly devastating for the shipping industry. You can see we had a much larger proportionate decrease in maritime trade versus GDP in 2009 as a result of the financial crisis. And what we had then was sort of leading up to the financial crisis, GDP was growing, the global economy was growing, and company order books were very high. So there was a large amount of container ships being ordered, more container ships on order than necessary for consumer demand. And then obviously there was a drop in GDP, and because there were so many container ships on order, this drop in GDP was pretty devastating for a lot of companies. We had a lot of more shipping carriers than necessarily vessel owners. I believe there was one major shipping carrier had a bankruptcy resulting from the situation. So it is obviously a concern.
Time. Thank you.
ESG is responsible investing. Who's responsible for building ESG into your investments? At PGIM, the pursuit is on for outperformance. As active investors to outdeliver with customized strategies, integrating ESG best practices into our investment decisions. As asset managers and fiduciaries to outserve with our commitment to better ESG outcomes. Join the pursuit of outperformance at PGIM, the investment management business of Prudential.
Welcome back to our teams, participants, and proud audience. The judges' scores are in, and we're ready to announce the winner. The winner of the 2022 CFA Institute Challenge is Northern Illinois University. Congratulations on this incredible achievement.
Thank you again to all our teams who presented today, our panel of judges, and our sponsors. A special congratulations to Northern Illinois University. And with that, the 2022 season of the CFA Institute Research Challenge is officially over. We'll see you next season.